Hey guys, today I'm Derek Wilkins and I'm with my cousin Drew. We're the owners of LTC Tree, and today we're going to talk about hybrid long-term care insurance. Now, before we get into the hybrid long-term care insurance, just a bit about us. Our company was founded in the late 90s, and it was founded, which is LTC Tree, it was founded on giving the consumers choices. Back when I started right out of college, I worked for one insurance company and we had our clients had one choice. We soon realized that, hey, if you truly want to be successful and give the clients the best experience, you want to work with all the companies. So LTC Tree, we help you shop the market and get the best deal. So our motto is we work for you, not the insurance companies. So as I mentioned, today we're going to give a high level kind of talk on what is hybrid long-term care insurance and kind of go over the pros and cons and kind of just go. There's traditional long-term care insurance. There's also hybrid long-term care insurance, and like I said, give the pros and cons of each side.
Yep, and we've got some graphs teed up to show, for example, what it costs to wait. By the way, I'm Drew with LTC Tree, Derek's cousin, and we both are licensed in all 50 states. And what we do on a day-to-day basis is help people buy and research long-term care insurance of hybrid and standard. So today we wanted to just put some information out there that's really hard to find on the internet, and that is what is what does this stuff even cost? If I'm a 55-year old, if I'm a 60, 65, 70-year old, what do I
Right.
pay? What do I get? And so we're going to break down those numbers and just give our opinions and perspectives on when it might be the right time to buy this, how you should research this, the companies to look at. So we've got a lot to go through today.
Yeah. So let's start off by just defining what is long-term care. What is the problem? So what long-term care is when you get to the point in life, it could be in your 50s from a car accident or like Christopher Reeve's situation. He fell off a horse and was a paraplegic for life. But most commonly, the average claim age is 85 years old. An older person gets to the point where they have trouble doing their activities of daily living. Now, what those are, they're eating, bathing, dressing, toileting, transferring, using the restroom, all the things that we take for granted. You may get to a point in your life where you have trouble doing those safely. So you have to receive care at home. You maybe have a home health care aide coming into the house to keep an eye on you, make you a sandwich, go to Costco food shopping for you, help you get in and out of the bathtub safely. An assisted living facility, those are kind of the apartment like facilities where you can put your own furniture in there, but it's kind of communal setting, and then all the way up to nursing homes. So that's kind of what long term care is. And the problem and why people buy this is it's expensive. What's the average cost of needing long term care in the US today, Drew?
It's probably about $100,000 a year. A lot of people are able to pull it off to stay at home, which is usually a little bit cheaper. In fact, that's the number one place people use their policies for benefits is in home, which is actually to me kind of a reassuring thing. But you get into assisted living, you're probably looking at 60 to $70,000. Nursing homes probably about 50% more than that, and that's just an average.
Yeah.
We hear numbers. A lot of people look at this because they're dealing with a parent, and so they're the one writing the check. What are some numbers you've heard lately on the low end and high end? Because there's a big range.
Yeah, like I've been talking to, seems like it kind of goes in waves. I've been talking to a lot of people in the Northeast of late, like a lot of people in Clemson, Pennsylvania, New Jersey, and a lot of them are coming to us because they're dealing with this with their parents right now. And I'm hearing like I had a lady last week in Pennsylvania. Her mom's paying about 11,000 a month for. I couldn't tell if it was an assisted living or nursing home, but it was a higher end place. But I mean, it's easy 100, like you said, 100,000 a year. And with such tight labor supply, even for home health care, just paying somebody 25 bucks an hour times 10 hours a day, that's 250 bucks a day. So it doesn't take long for that really to start to eat away at a person's assets.
Right. And before we go too far down the doom and gloom road, the reality is most people buy a long term care policy to hedge part of the risk. I mean, I see a lot of people that we have a candid discussion, and it's like, well, I don't want to spend $200,000 on one of these policies. I would rather, have say half the cost covered. So that's a kind of a
Yeah.
practical way to save money with this is take that big, scary, expensive number, back off of it and insure, say, half of it because you're going to have other resources potentially to cover the other half.
Yeah, because you're dealing with risk, and risk is you always face with the fact that you might buy this and never use it. So if you kind of diversify, maybe get a smaller insurance policy and then self-insure the other part of the risk, that's usually a strategy we do with a lot of our clients. And and there's a couple types of solutions that we have. One is traditional long-term care insurance, which is most people do know what that is. It's like your homeowners, your auto insurance. You're just paying an annual premium. You have a coverage to use if you need care, but it's use it or lose it. But you have to pay that premium for the rest of your life or until you need it. Hybrid long-term care insurance, which has come in vogue the past 10 years, since the traditional plans have had these rate increases, it was developed where, as opposed to making a premium for the rest of your life, you pay it off upfront over 5 years, or you have a 10-year payment option. So whatever payment option you choose, the premium's guaranteed and it's paid off, and it's going to give you three core features. You're going to have a long-term care benefit, which ballpark for an average client, maybe it gives you about a 1 to 4 leverage immediately. So that means if you put in 100,000 to the policy, you'd have about $400,000 of long-term care insurance. You have a life insurance benefit, and then you have a cash value benefit.
Yep, and we're going to show some specific numbers here in just a few minutes. I've got some pretty cool graphs. We're going to show what you get if you pay over 10 years, what you get if you pay up front, and we're going to give specifics for actual ages of some policies that are on the market. So you've got the traditional, and I'm going to stop and back up for 1 second because this is really important.
Yeah.
The traditional plans have gone out of vogue and the hybrids have come in vogue because of something you just said, which is rate increases. So a lot of people are familiar with it, but some may not be familiar with what we're talking about when we say rate increases.
Yeah, rate increases are the insurance companies have what are called actuaries, and they kind of look at a risk and they try to make a prediction on a block of people, a block of 60-year-old women in Colorado. In 20 years, what percentage of those are going to file long-term care claims? And if so, for how long? They make a prediction, and they use that prediction to come up with pricing on how to price insurance products. Now, back when these insurance companies were doing this actuarial math, interest rates back in the 90s were 5-6%. We then had the Fed from really what 2005 to like just recently, interest rates were at rock bottom levels for 15, 20 years. A lot of the insurance companies, they just did not predict that low interest rate environment. Tackle on that people are living longer. So a lot of these traditional plans had the rate increases. So that's where, insurance companies are good. It's coming up with products to solve problems. And this is where hybrid long-term care insurance came up, offering a guaranteed premium, and you get your money back if you never use it.
So that's the biggest advantage is if you do it right and you work with someone who knows what they're doing, you can get a fully guaranteed paid up policy, and the insurance company can never come back to the well for more premium. And that's what we're going to be talking about today. So, I guess there's sort of like the big why. Why would somebody want to set aside money for long-term care from a financial impact? Like, let's just kind of go down that road for a minute and sort of get into the heads of why people buy this. Sophisticated people buy this type of policy.
Yeah, it's the hybrid long-term care plans. It's usually for the slightly higher net worth clients. I'm not saying people who have millions and millions of dollars. I'd probably say $500,000 or higher tend to gravitate towards the hybrid plans. And why they do it is because for diversification, because most people, they have their money invested in fixed assets, like maybe it's in a CD earning 5% right now with rates so high, but the majority of it's going to be in risk assets like stocks, bonds, things of that nature. So they'll buy hybrid long-term care insurance for the guarantees that offers, which the stock market doesn't. Like if you want to self-insure and then you need long-term care in the year 2022 when the market was down 30%, that's not the best time to be selling your assets to pay for your long-term care. But at the same time, you don't want to put all your money in the insurance side. So people will use the long-term care insurance just as a diversification play. And also there's tax benefits. So if you self-insure, you sell your stocks to pay for your care, you got to pay capital gains taxes on the growth versus long-term care insurance. The benefits are paid tax-free.
Right. And I think that tax free is a really key part of this because if we just save our own money, we can do that and we'll get a return with all the risk that comes along with it. But you have to pay capital gains on it when you want to cash it out. So inside of this policy, we'll typically set up, and we'll look at this in a minute, a compound inflation protection rider that's growing your benefit every year. And as long as you use that money for long-term care benefits, that growth is tax-free. So it's kind of a nice way to beat the system legally. It's part of the tax code. It favors these types of policies.
Yeah, yeah. So Drew, I was talking with Hannah, who's a part of our team. She put together some of these graphs and figures. Do you have that you want to get into now that you can show?
Yep, I'll pull it up in just a second. Let's take a look here. So we're going to go to a sort of a split screen view here where we've got a graph.
All right, I see all these colors. What do they mean?
Yeah, I know. When you first look at this, it's a little overwhelming. We'll leave this up here for a little bit in case somebody wants to pause it and study this. I know when I'm watching YouTube videos about a product or whatever, it's nice to see actual real numbers. So what we have here is a hybrid plan where a male, and we did the same thing for female, so we've got the numbers for those as well. A male, in this case, pays premiums over 10 years. Now, that's the plan design that a lot of our younger clients will use. Like if you're in your 50s or early 60s, you might want to I always use the term sort of dollar cost average into one of these policies. In other words, rather than just stroking one check and paying it off, we're going to pay it over 10 years. So what we did on this graph, and then I'll show you the exact same graph with a single premium. What we did is we said, okay, if you're 50 years old, so let's just start with this first set of numbers here. If you're 50 years old, and once you see how this works, the rest of the numbers will all make sense. And you put in $10,000 a year for 10 years into one of the market leading policies. We'll leave the name out just for comparison's sake, but we'll be happy to provide exact quotes for somebody if they want them. Anyway, what do they get for their 10 grand a year for 10 years? And they get 3 benefits that are all sort of linked together. So I'll let you kind of take over from here and explain what people are looking at if you'd like.
Yeah. So what you're looking at here is we're talking about leverage on your money. So this is if you give the insurance company $100,000, what do you get for that money? So as you can see, you give the insurance company $100,000. Right now, they give you, I guess the blue line represents, I'm going to look closely.
Your day one long-term care.
Yeah, your day one long-term care benefits. Statistically, you're not going to use this till you're 85. So the yellow line represents what your long-term care benefits have grown to over time. Now, the red number, you can see that kind of stays pretty much the same. And that's your the life insurance value.
Right. So let's say that let's just take this 50-year-old and we'll just run through the numbers. I'll do it. So 10 grand a year, he pays in. And let's say that, he gets this thing fully paid up after 10 years. Not that he has to. You could actually make a claim in the first year, but typically most people are going to buy this and live a healthy life. When he's 80 years old, his long-term care benefits will have grown on this policy from just that little 10 grand a year over 10 years to $1.2 million. And we're just looking at this first column. Let's say that this same gentleman wants to spend the same money, but he waits until he's 55. That's where this next set of numbers comes in. So when he's 55, if he bought the plan, paid the same money, he's only going to get $990,000 in long-term care when he's 80 years old. So, and you can see that just kind of cascades down. It's advantageous whenever you decide that you want to buy one of these policies and you're healthy enough to qualify. It's advantageous to buy it at a younger age if you can. Now, having said that, the 70-year-old, or say the 65-year-old, more common, who has waited, still gets a tremendous value out of one of these policies. They just don't get as much as if they had bought it 10 years earlier. But the value proposition is good across the board. It's just very favorable to encourage younger people to buy these policies.
Yeah. So, I think the bottom line to sum this up is, we're not saying that long-term care insurance is for everybody and it's going to solve all your problems, but for a portion of your portfolio, it makes a lot of sense just to put a percentage of your assets that maybe they're in the fixed assets right now, just to get that leverage effect. Because I mean, you can see, you put in 100 at age 50, 1.2 million by the time you're age 85, tax free. There's really no investment in the world that you can do that to have guaranteed benefits available. Now, this also comes with the fact that you know your health history, you know your own your health, your family's health better than anybody.
Right.
If you don't think that you're going to need long-term care, then don't get it. So that's where you have to have an honest conversation with yourself and say, what do you think my chances are at actually needing long-term care are? And if you think they're higher, then maybe you hedge your risk a little bit and get a modest policy.
Exactly, and that's what I see most people doing. So, we used $100,000 example here, and our 50-year-old got 1.2 million in benefits by the time he's 80 years old. And again, 85 is more like an average, so the number is going to keep growing after age 80. But let's say that 50-year-old doesn't want to put 10 grand a year in for 10 years. He only wants to put in 5 grand for 5 years, or
Right.
for 10 years. 5 grand, 10 years, that's pretty manageable for the type of person who's buying this. He's going to have $600,000 in benefits. But let's look at, I'm going to pull up another chart here. Let's look up an example where the same numbers are there, but we have a single premium. Because that's actually, I would say that's probably how a little bit more, a higher percentage of people do this is with
Yeah.
a single premium. And that's where you get a better value proposition. So in this example, and again, I'll just kind of put these side by side, not side by side, but like overlay them. So this policyholder had 1.2 million. If he pays it up front instead of over 10 years, he gets $200,000 more in long-term care benefits when he's 80 years old. So again, they stack it up so that it's advantageous to pay a single premium if you can handle it rather than pay it over 10 years. Should be pretty obvious. Anybody with finance knowledge. But how do you counsel people on that in terms of which way they should go, 10 pay versus single pay if they're doing this concept?
That's a good question. And it really just comes down to the size of their portfolio. Like if somebody's hovering around $500,000, that's usually where we'll see the the five pay. Like the five pay, I think is a pretty good value for people even who don't have, over $1 million. But if it's sometimes people who have slightly less than $500,000 of assets, they still want the hybrid plans. That's when we'll go the 10 pay option. Maybe they have a good income that they're, maybe they're 52 years old. They got another 15 years they're going to work. They want to pay this off with their own income while they're working. Um, but for the most part, if clients, 750,000 above, they tend to gravitate towards just paying it once and it's paid off because this is roughly speaking, when you pay a single premium versus a 5 year versus a 10 year, there's probably about a 10% reduction in benefits if you go from single premium to paying it over 5 years. Another 10% if you go from paying it over 5 years to 10 years. So that's just kind of a rule of thumb. But I guess that's kind of how we counsel. If higher net worth clients, probably 750 and above, they tend to do it, the single premium option.
Yeah. And, a lot of this is going to be very specific to you as a potential policyholder's individual situation and needs. And so one of the things we do here at LTC Tree, and I'll just kind of run through our process, is we're going to provide you the specific numbers for you. What is it going to cost you if you pay it up front over 5 years, over 10 years? We'll see the real numbers and how they play out for you. And we are just two members of our nationwide team here. We've got agents all over the country. I'm in the West, Eric's in the East. We have agents, around the country that are independent agents and can help you figure out which plan from a company perspective makes sense and how to pay the premiums.
Yeah. So, you know, I started doing this right out of college in 1999. And as I mentioned earlier, I was working for John Hancock, and it was just John Hancock for everybody. And it was a great company, but again, like I said, we soon realized that there's no one shoe that's going to fit all the feet, because everybody's financial situation is a little bit different. So, this is when the internet was early getting started. Drew kind of we joined forces. He had a tech background, and we asked ourselves the question: how can we use the internet, the web in the early 2000s to give the consumers choices? And you have choices that usually gives the consumers power. So that's where LTC Tree kind of formed, and we just really started doing a deep dive of all the companies that were out there, and kind of hand selected, hand curated the best, absolute best products out there. And that's kind of what we still do today is we've kind of shop the market for you, and we'll show you what company is giving you the most benefit for the dollar put in at the lowest price, with balancing with the company's financial ratings. Because obviously you want to go with a company that has good financial ratings that are going to be there to pay your claim in 30 years.
And it's a huge breath of fresh air for a lot of our analytical clients. People that come to us tend to be the type of person who they want to get a second opinion, and we highly recommend that. Oftentimes, and we can give some kind of specifics, they've seen perhaps this concept from their financial planner. Perhaps their financial planner either sells insurance or works with someone in their office who does. And quite often, that's not necessarily the best deal. I'll give an example, and I won't mention any company names, but just sort of an example, I had a gentleman come to me that had seen two different major blue chip companies, reputable companies, had seen their hybrid plans, and A plus plus rated companies. You've seen commercials for them recently, I can assure you. But he wanted to see just a few additional quotes, and we were able to find him 20% more in benefits and give him a cash indemnity, which if that means nothing, we have some videos on it. Give him a better policy from an A plus rated insurer and 20% more benefits. I mean, that's a pretty major advantage to like shopping the whole market versus just looking at what you get from one example, or from your financial planner's one example.
Yeah, and that's a good point. We're getting a lot of clients who, they visit their financial advisor. The financial advisor brings up the topic of, planning for long-term care, which is a good thing. But the advisor sometimes can offer them a solution, but it's usually just one solution. And often the advisor, their wheelhouse is investing. They could give better mutual fund recommendations than Drew and I. But they just only dabble in the hybrid long-term care plans. And there's a lot of moving parts that will be important for you when you go to use your policy, that unless you do this daily, the advisor is just not going to know. So consumers are smart people. So they usually pick up on this and they do some searches and they find us. And that's kind of what we do is we'll go over the pros and cons of these products. Hey, company A has this, company B has this, one's an advantage, one's a disadvantage. Which do you like that fits your situation?
Right. And we should also mention, I mean, I think it's important for people to have a little context of sort of our background. You mentioned why we started this company. One little
Yeah.
interesting thing, and I know you don't talk about this too much. We are family, so my dad and your mom were brother and sister. Both have unfortunately
Yeah.
passed away after both of them needing long-term care. But when you
Yeah.
first got in this, let's just tell the story. One of the first things you did after you got in this business was buy a policy for your mom. And this is kind of off the cuff. We haven't scripted this part, but could you just share a little
Yeah.
bit about the story, because she ended up needing that policy, right? But just give us a few
Yeah,
little
that's
points.
true. Yeah. I was just right out of college, and, wanted to obviously get my first sale, and my parents weren't the first sale. They wanted me to kind of get my feet wet, just, because they didn't even know what this long-term care insurance was. But once I learned about it, I knew my mom's history. She was a little bit overweight, and she had some knee problems because she played basketball in college. And I could just kind of predict, she was maybe early 60s, that, hey, few years from now, she might need to use this. So my dad, he signed up pretty early on. My mom, it took her a couple of years to come around, but she ended up getting a policy, and she had her knees replaced. One of her friends got her knees replaced, and she said, "Oh, I feel so much better. I got my knees replaced." And so my mom, I want to do it too. And she had them replaced, but she ended up falling the day after the surgery and tore all the knee ligaments in one of her knees. 15 surgeries later, she never got out of the wheelchair. and she ended up needing care for 13 years before she passed away. Um, and thankfully, she had a policy that paid all throughout that time. Now we had it wasn't an unlimited policy, but it was a policy that had a cap on it. But we kind of had to turn it off and on, and use it kind of sparingly to give my dad some assistance. But I mean, to this date, that's the longest claim. It was my own mom that I've ever dealt with. 13 years. Yeah.
And I think that's just a crazy story.
Yeah.
My dad was only in a nursing home for just a couple of weeks, and so that's what makes this insurance work is that some people will need it more and some will need it less. Uh, your dad's how old now?
He's 86. Yeah, and so
86
he's
and
still,
rocking. Yeah.
yeah, still going strong. So, but
So,
he does
so
have
he's
still
paid
has this
premiums for
policy too.
20 years on his policy, but he might ultimately need it. I have a policy for my mom. She will probably ultimately need it. Hopefully not. But it's just one of those things. I think, when you hear a story like that and how useful it was to have that money over 13 years to help put her in better places. When I went to visit her, she was in a very nice assisted living. I mean, it
Yeah.
felt like a 3.5, 4-star hotel to me.
Yeah. No, when you have the insurance company paying the bill, you can afford to put your loved one in a nice place, or you can put your own self in a nice place, or put your wife, put your husband, without having to worry about how you're going to pay, for their care, plus pay the mortgage, buy food, the power bill, car payments, all the stuff that you still have to pay, even if your spouse is in needing care. It just kind of gives you peace of mind, as well. And my dad, he comments this on all the time. He's like, Derek, I might never use this, but it just gives me good peace of mind. It's just one less thing that he has to worry about when his head hits the pillow at night. Is what happens if I need long-term care? What if? So this long-term care insurance solves that problem.
Yeah, and similarly for me, that peace of mind thing with my mom, she's healthy, she's on no medications, mid
Yeah.
70s.
Wow.
If
Yeah.
mom is watching this, I'm sorry I just said what your age is because she
Yeah.
said she's gotten to the point where she used to lie about her own age, now she has to lie about her kid's age because that ages her out. But anyway, anytime I think about like go 10, 15 years, 20 years into the future and she's in her mid 90s, I have that peace of mind of knowing, well, we're going to have a little bit of help. I mean, we only bought a $3,000 monthly benefit, but that's going to grow and take a big chunk out of the cost should we need it. So, you know, um, if somebody wants the specific numbers, I'm going to link to a blog post that we're releasing with this same video in the comments or in the description below. You can link and see those charts that we showed earlier. I would encourage anybody who's watched enough of this to be interested in the topic to reach out to someone like us to request a quote and get some specifics for your situation. I think that would probably be a good next step for a lot of people.
Yeah, so Drew, obviously, if they're watching this video and you spent, 15 minutes with us, we'd love to the opportunity to just talk with you and just show you all the options that are out there. So Drew, you want to walk the people through what is LTC Tree's process? How does it work? How can they get more information?
Yeah, so if you're not ready to jump in and get a quote, you can tune out now. If you're interested in getting a quote, we have a very streamlined process. So we've actually, I'm kind of the tech guy here. We've written custom software where when someone comes on our website and requests a quote, we just need a little bit of information about them. We're then, after a short conversation, able to have a very in-depth, detailed illustration put together of multiple companies side by side. So we're not just going to say, "Hey, this is the best one. Just take my word for it." No. We're actually going to say, "Here is company A, B, C, and D. Here are what their premiums and benefits are for you. Now, here's why we think this one may be better. This one may not be better." But we're going to show you all the numbers and then be able to talk about the pros and cons. And when I say we're going to show you the numbers, we're not going to make you do a Zoom conversation. We can get these quotes to you so you can review them at your leisure and not feel pressured to make a quick decision. I mean, I think if we look at it, how long do you think it takes from when somebody fills out the quote form to when they decide they want to buy this? I mean, it takes months, and we're fine with that, perfectly fine with that.
Yeah, I mean, it takes months, if not years, and we want you to do it when you're ready, and it's one of that's kind of the DNA of LTC Tree is we work for you, and that means we also work on your timeline. And we've been doing this long enough, so Drew and I are going to be paying our mortgage from the commission on your sale, so you can take as much time as you want. I had a guy who 12 years ago he filled out the form. I guess it was in 2011. Something happened with his parents. That's what triggered him. And he's in underwriting right now. So, some people are just, they call us up and they're ready to go right away. Some people it takes some 12 years. So, whatever your situation, we'll be here. It's all the same to us.
Perfect. So, like I said, I'll put a link to the blog post with all the graphs so you can see some generic information. On that same web page, there will be a form if you want to get a quote for yourself. If not, we're going to keep releasing YouTube videos covering this topic in greater detail over the next few months. So, if you're watching this relatively recent after we produce it, just stay tuned, subscribe to our channel. We're dedicated to getting the real information out there on what's really going on with the hybrid plans without bias.
Yeah. So if you like what we produce, if you like the video. Andrew's going to put in the link to get the quotes in the link below. Click it, and you'll talk to one of us, and we'll get you the quotes shipped to your front door.
Sounds great. Well, Derek, thanks for taking the time to chat with me on this, and hopefully some folks found it useful. And I'll catch you later on.
You got it. See you guys. Thank you.